7:42, 18 moving up to 8 o'clock. Don't forget, 6 o'clock this evening, we had the premiere episode last night of our new show called Crackdown. We dealt with the issue of marijuana in Trinidad and Tobago. Today, we are dealing with dangerous driving, and I bet you will not imagine the types of videos. We've gotten some videos of people with crazy driving in Trinidad and Tobago, and some road rage too. You would not believe what happens on the roads of Trinidad and Tobago, perpetrated by, yes, all of us. That's at 6 o'clock this evening across platform, CTV, Talk City, and also ctntworld.com. And you can also participate across the board. So I'll be viewing at 6 this evening. Right now, we welcome our friends from the Unit Trust Corporation, Akhenaton Marcano, who is an AVP Risk at the UTC, and also Mr. Phillip Williams, Portfolio Manager. Gentlemen, good morning.
Morning to you.
Thank you for joining us. Today we're talking about volatility, and volatility in the market, I presume. Yeah. Or with various parts of the market. Let's define volatility.
Well, Paul, first of all, thank you for having us here again. It's always a pleasure to be in here at CNMG and actually sharing our insights into the world of investments and financial planning with your viewers. Volatility, we believe, can both be a friend or foe, and is simply defined as the unpredictable changes or fluctuations in the values of individual assets or the overall market. An market or an asset of higher volatility has more dramatic changes in value than one of lower volatility. So it's something that investors face every day in the market, but sometimes don't understand how it can be to their benefit or to their detriment. It just needs to be managed.
When we say that the fluctuations, and you say it can be an advantage or disadvantage, most people fear volatility. They generally look for stability in any market or any commodity or asset. How can it be an advantage?
Well, volatility, because it offers both upside and downside, can be an advantage. If you are able to understand that it's the reaction of the market to new pieces of information or new data coming in, and how the market participants perceive that information, how they interpret it, then you can decide whether your estimation of the value of the asset or the market is aligned to the market's estimation, and therefore, if you believe the market has overreacted, you can take a position that I can stay invested or even increase my investment. Or if you agree with the market, you can actually also follow their path. But it is important to have a calm, collected decision as opposed to just following the herd and reacting.
Now, Phillip, William, let's bring you into the conversation. Most people who have invested in assets or commodities have expectation based on past trends, where these markets or commodities and the environment in which they exist, and also the contributing factors to the volatility where these are concerned. How do we get all this, if we're not experts like you, into our head? And what should we be looking for in terms of whether the volatility is sustained or temporary?
Well, certainly, Paul, you mentioned an expectation of a return. As an investor, you have an expectation. Okay, you purchase this asset and you say, well, listen, down the road, I expect this type of return to get me to this point. It's important to know that volatility can come from anywhere, and just to reiterate Akhenaton's point, as in it can be a friend and it can be a foe. But certainly what you want to look for, you don't need to be an expert, all right? If I'm looking at a company, all right, I want to know what type of cash the company has on hand. Does it have access to internal liquidity? Can it meet its liabilities? Does it have access to external liabilities? How efficient are the managers running this company? At the end of the day, a business is there to make a profit. So I want to look and see, well, what are the trends of profit? Is profit expanding continuously? And what type of financial risk? If a company is highly levered, well, has taken on too much debt, then it begs the question, well, what is the likelihood of you being able to service this debt? Right? And that will speak directly to the credit rating and what is the cost to borrow. So these are the simple things, little tools that an investor can have in its back pocket. And at the end of the day, if you don't feel that you are confident enough in terms of the information that you have assimilated, you can pick up the phone and you can call us at the Unit Trust Corporation, the likes of Akhenaton and myself, to get a broader picture and see through the fog, what it is.
Let's take it out of the realm of theory now into the realm of practicality, and two examples: the energy sector and the technology sector. Let's start with the energy sector. And when you see volatility in the Middle East. And it affects the volatility of oil prices or energy companies.
Right.
How should the average investor view that in the context of his or her investment? Looking down the road, we see issues with Syria, sometimes uprising in the Middle East, sending the price of oil actually up or down, affecting energy companies. What are the parameters to one understanding? Don't hit the panic button, or, well, you know what, it's going below my comfort level.
Well, one of the things to process in terms of energy, the energy sector, is an inherently volatile sector because you're dealing with a commodity, and therefore both supply and demand factors push and pull on the price at any point in time. Oil in particular is, as you quite rightly pointed out, Paul, is susceptible to some political or geopolitical issues. And so any noise in the Middle East creates the fear of a potential disruption in supply. And that is what drives the volatility in the price at one side. There's also other pressures on energy prices where that actually are positive on the supply side. So for example, the shale gas developments in North America are actually creating a situation that can put downward pressure on energy prices, oil prices in particular. So you have to look at the collective. You have to focus on which particular issue at the point in time is driving or taking top priority. So for now it is Syria, but we understand that there is a diplomatic initiative involving Russia and the US that may avoid a military strike. I stress the word may. But you also have to look at other factors that can affect oil prices right now. And that includes even the Federal Reserve action that's going to take place in the next couple of days, I believe, Philip, correct me if I'm wrong.
Yeah.
And so it's always a collective. You don't want to overreact to one data point. You want to look for a trend, and also know in the energy space, it's a cycle. There's always something happening.
So don't panic.
Yeah, don't panic.
But keep a keen eye.
Keep a keen eye. Keep informed.
Yeah, Philip, let's look at the tech sector and make comparatives between a company like Apple, long history, high stock value, as opposed to BlackBerry. When you hear BlackBerry, maybe looking to sell.
Yeah.
Because of continued poor performance of their products and what it means to stockholders on either end of that continuum.
You see, I think, looking at Apple, looking at BlackBerry, it's interesting now to see how the market reacted to Apple when the price declined from $700 to where it is today. It's around in the $460 level. Apple came out with 2 new products, and I think because the anticipation that the market had that, well, maybe these will be so excellent, actually that put downward pressure on the price. The situation with BlackBerry now, the tech sector is one where you have to be constantly innovating. So actually, in a sense, sometimes it's very difficult to predict the earnings of a tech sector. I'll be very honest with you.
But when you look at the trends, now BlackBerry has been trending down while Apple may have some volatility, but it's a relatively stable company.
Value. There's value, and there's value in Apple when you just look strictly at the balance sheet. There's a lot of strength in the balance sheet. You look at their earnings, it's consistent. You look at how the management has run the company. It's a well-run company. But this is a situation, Paul, where what I want to reiterate is that perception, sometimes it will become the reality for right or wrong now. What happens 3 months down the road? What happens 6 months down the road when the price has rebounded now? So you were holding Apple stock and you said, you know what? It was at about $500 a couple of weeks ago. Now it's at $460. What does that mean for me? Yes, when you look at your statement, you see that your capital has eroded, but you haven't realized that loss because you haven't sold it. If you went and you sold the asset now, you put yourself in a situation where you don't
absorb
stand.
The loss.
You absorb the loss, and you have lost out now on this opportunity to recoup and actually move down the road to achieve the goal that you.
But then again, the decision to hold on also, as both of you said, hinges on the history of the company and the balance book. So that more than likely, Apple is going to rebound at some point and give you more value so you can hold on when it gets back to $900.
Yeah.
If you feel this at that point, you would have gained. If you sold at $400, you lost out. Let's bring it back to Trinidad and Tobago now with an IPO like First Citizens in the market. Sorry to mention a competitor, but I mean, that's the reality of what people are looking at in terms of investment, as opposed to, that's new, and the UTC has these stable products that have been in existence for a while, 20-year history and stability. and how the public should balance those or reconcile those decisions?
Well, actually, just to correct you slightly, Paul, we have a 30-year history.
Sorry, 30-year history, my bad.
That's all right. But in terms of the point you're making about the stability of the funds, I would like to emphasize that, and therefore different volatility profiles.
Which means you're balancing your risk profile.
Yeah. Right. Mm-hmm. So when we look at an instrument or an asset like FCB, we try to locate FCB's value and potential for variation in that value, and locate it in the funds that fits that profile. Mm-hmm. So we have income funds, TT dollar income fund and the US dollar income fund, that offer the unit holder a fixed unit price of $20. So that means your principal value never varies. Mm-hmm. A fund like that, you wouldn't put an asset that can vary a lot in it, yeah. Right? Mm-hmm. So those funds have bonds and short-term fixed income instruments. So an FCB share will not be in those funds. Mm-hmm. A unit holder coming to those funds knows he has a fixed unit price, so there's no volatility to him. Mm-hmm. We have...
It's a low-risk investment.
Yeah. Yes. We also have a growth and income fund that's denominated in TT dollars. That fund can invest in equities as well as fixed income. So a fund like that can hold an equity instrument like First Citizens Bank. When we enter into an instrument, we always try to look at the incremental contribution of that instrument to the overall risk and return of the portfolio. So we would assess any new instrument, FCB as well, and see how much of it can we take into the fund, if any at all, and how that will align to the overall volatility and risk that we want for that fund and that we have sold to the unit holder. So the growth and income fund, for example, has a 3-year price guarantee once you stay continuously invested for that 3 years. Mm-hmm. So we try very much to manage the volatility in that fund. There will be some, but we try to manage it in a way so that we can secure and enforce the guarantee to unit holders.
So, put in short, one of the mantras of the UTC is always diversify.
Correct.
And that lowers your risk portfolio.
Correct.
That's so?
Correct.
Phillip?
That's absolutely correct. That's one of the techniques that we use to manage volatility, mm-hmm. along with dollar cost averaging, right, which gives you the opportunity. It's essentially purchasing an asset at a lower price and mm-hmm. would afford you the opportunity to gain more. But certainly diversifying is a tool to mitigate, to minimize the risk of volatility.
How much attention should investors be paying to the annual, what's become an annual ritual in the US scenario, where they're going toward this fiscal cliff nonsense again? Sorry to say it's nonsense, but I mean, we know they're going to end up deciding, coming to agreement just before the end, but score their political points before. But it has some effect on the markets. You
are absolutely correct, Paul. Volatility can come from anywhere. You mentioned Syria, right? Syria is one of the issues that, well, last week it came to the back burner. So if someone just, for instance, if you wanted to measure volatility, there's an index, right, VIX. If you wanted to see where volatility is today, you can go to Google Finance, go to Yahoo Finance. See where volatility was at the height of the crisis, 2008, 2009, where it was in the 50 levels. So
there's a general volatility index.
There's an index, okay. All right? So certainly that is what you want to pay attention to, critical data points that will impact the psyche of an investor. When central banks meet, they basically come into... Do individual
commodities or assets have a comparative to the general volatility index in terms of where they sit in contribution to that?
Well, yes, you can calculate the volatility of an individual asset or instrument. It's called the standard deviation. It's a mathematical formula. You can probably get off Excel, but I think
we all hear that all back home.
But I also believe you can derive that information from the similar data sources that Phillip just cited, and it's don't get into the calculation so much. Just look at the level, and so if you see a volatility of or standard deviation of 5% versus 1 or 4%, just know 5% means it's more volatile. You
go wide on the bell curve,
yes,
so you're in more trouble.
What bell curve?
You have to do some research. All right, gentlemen. Once again, more information at ttutc.com or org.
.com.
TTC. All right, thank you very much, Akhenaton Marcano and Phillip Williams, for adding that clarity of volatility. And you can also get more information by going into the UTC's headquarters or any of their branches throughout Trinidad and Tobago. Thanks once again.
Thank you for having us here.
All right, you're quite welcome. And don't forget, 6 o'clock this evening. Don't move yet. Crackdown right here on CTV and our major news at 7 o'clock. Have a great day. Be safe.